Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, January 8th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is leading survey data confirm our expectation for the resiliency of the U.S. economy to begin dissipating in 4Q23. Unpacking the nuance, Friday's December ISM Services PMI report confirmed what the New York Fed Business Leaders Survey signaled a few weeks ago, is that growth in the services sector is cooling off. Most notably, the employment PMI declined to the lowest level since July of 2020 via the slowest month-over-month pace since the nationwide COVID lockdown of April 2020. Fortuitously, the 42 macro Fab 5 recession signaling indicators and jobless claims currently signal only a low to middling probability of a recession over the near term. And then lastly, the market implications of this data is that the preponderance of key economic data must continue to support the soft landing consensus embedded in money market pricing for the Goldilocks top-down market regime to persist. The December ISM Services PMI report was indeed supportive of that outcome. Transitioning to my 42 macro dashboard here. This morning, got a full slate of research here. Got the macro scouting report published this Friday, so definitely make sure you guys are taking some time to unpack that, particularly the qualitative research and the modal outcome, left tail risk and right tail risk sections. Obviously, got around the horn from Saturday and this morning's leadoff morning note. But we'll draw your eyes to our signals from our friends over at Longbow. We're getting oversold signals here in the 10-year nominal treasury, overbought signals in the 10-year nominal treasury yield, overbought signal in the 10-year TIPS yield as well. Short-term momentum is neutral now. It had been bearish, so we're losing a lot of that price momentum, that kind of that aggressive chase into the bond market starting in late October, early November there from a short-term momentum signaling standpoint. And then lastly, transitioning to our 42 macro community, getting a question here. Regarding the QRA announcement, it reads, "Hello team, I'm a newbie. Curious if Darius will be breaking down the issuance composition from the QRA announcement at the end of this month and how it will impact the bond market." So yes, we do that every quarterly refunding announcement. We do a deep dive on that in the leadoff morning note. We also feature that deep dive in our macro scouting report as well. The general takeaways is that Yellen continues to starve the market, the primary market, with starve the market of bond securities, which is obviously accomplishing two things. One, it's taking the bite out of the quantitative tightening program or balance sheet roll off, really. I don't call it quantitative tightening because the Fed isn't selling bonds to the market, but it's taking the bite out of the Fed's balance sheet roll off program, and it's also reducing the pressure upon the secondary market in terms of for investors being having to sell other assets to capitalize Uncle Sam. So she's doing a great job of attacking the roughly $700 billion that's still left in the reverse repo facility balance as a sort of repository for T-bill issuance, as excess demand for T-bills, and until that number gets down towards zero, we're going to continue to see that kind of policy, particularly in a presidential election year. She's highly incentivized to not cause issues in financial markets with the Treasury's net financing scheme. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, January 8th. Everyone have a wonderful day. Best of luck out there, and we will catch you back here on Wednesday. I will be offline tomorrow for obvious reasons. Go Huskies. Cheers.